Hello, everyone. Thanks for joining us here on MarketBeat's YouTube channel. We have Chris Markoch back with us. How are you doing today, Chris?
I'm doing great, Lacey. How are you?
You know what? I'm doing okay. We got a lot of snow here in Sioux Falls, so just trying to get through that, hoping for some warmer days ahead.
We're just getting rid of our snow, so.
All right. Well, today we're going to discuss Disney. Many are enchanted by the magic of Disney, from the thrilling rides at their theme parks to the beloved characters that grace the screens of our movie theaters and TVs. It's no secret that Disney has a special place in the hearts of many around the world. Chris, have you ever been to Disney?
I have, not for many years, but I've been there, Disney World, not Disneyland, but I've been there several times, yes.
Fun. All right, let's just get into it. In this video, we'll take a closer look at Disney's financial performance and discuss if it really can be deemed as the happiest place on earth, even with everything surrounding this stock. So, Chris, Disney's stock price is down over 7% since Bob Iger was reinstated as CEO. Everyone says the Disney brand is worldwide and universally loved. Or is it? What is actually going on with this stock?
Well, I was taking a look at the stock yesterday, a little bit of a closer look at it than I had been doing over the last month. So one of the things that I like to do is when I see a price action like this is to look at some of the fundamentals that are going on with the stock. And because analysts usually try to price stocks based on current and projected earnings. So I went back to 2019, and that was obviously the year before the pandemic, and Disney delivered revenue of $69 billion. And earnings per share that year were $5.87. So I ignored 2020, and I ignored 2021 because I didn't think that was a fair comp either. And I went to just last year. And in the last year, Disney delivered $82.7 billion of revenue, but their earnings per share came in at $3.53. So more revenue, but less profit. And since earnings are the biggest driver of stock price growth, and in the case of Disney, their earnings are down nearly 40%, it's really not too much of a surprise that Disney stock is down 38% since the beginning of 2020. It seems to me that analysts are trying to price Disney for where they see earnings being right now. And they could also be noting that Disney doesn't have a dividend. They suspended it in 2020, and that takes away one of the longtime attractions of holding Disney stock.
So I get what you're saying, Chris, but what explains that drop in earnings? We keep hearing attendance is up at the theme parks, so how does that make sense?
You're right. I know when I look at my social media timelines this year, I've noticed a lot of friends that have gone to Disney. I think that's probably the revenge travel thing. And the park segment did deliver.
Chris, why do I feel like you're about to follow this up with a but statement?
Because it did deliver a $1.5 billion profit, but that only served to offset a $1.5 billion loss in the company's streaming business, Disney Plus. Now, I don't want to make fun of Disney Plus. It was a life preserver for Disney when the pandemic hit. But Disney's finding out the same thing that other streaming companies like Netflix are discovering, and that's streaming is a difficult business model. Disney was supposed to have an advantage because they had so much legacy content. I know that if my children were much younger, I would probably own Disney Plus only because of that content. But Disney's discovered that they have to generate original content, and original content costs money to develop. So again, that means streaming is a fairly difficult business model. And Disney has responded to that with an ad-supported tier for Disney Plus. But that is leading to another problem, and that is that one reason that some people believe Bob Chapek might have been pushed out is because there's a belief that the losses in Disney Plus are much greater than those that are being reported.
So, Chris, in an article for MarketBeat after Iger was reappointed, you wrote that the problems with Disney were more than just financial issues. But I mean, clearly Disney has been in the news for more than its financial woes, right? Do you still believe that?
I do. I'm a big believer in the fact that investor sentiment is a real thing. It's not always rational, but markets aren't always rational. It's not necessarily long lasting, but it's real. In that article, I wrote that in less than 2 years, Disney's gone from being the happiest place on earth to being a place where everyone seems miserable. And since I wrote that article, because I thought, okay, maybe I was a little hard on Disney, but since I wrote that article, both Disneyland and Walt Disney World issued a courtesy warning to their guests because of incidents of violence at their theme parks. And I'm not talking just verbal, I'm talking there was physical violence.
Yeah.
Additionally, or anecdotally, I should say, I've heard from people who have canceled their Disney Plus subscriptions. Anecdotally, I've heard from people who are rethinking or canceling plans that they may have had to go to Disney. Having said that, what people say and what people do are different things. So ultimately, the numbers will tell the story. I think Disney reports earnings in early February. So that'll be the first look that investors get at what's going on.
Okay, so Chris, where do you see the Disney stock going?
The analysts that are tracked on the MarketBeat site give the stock a moderate buy rating, and they have a consensus price target of $128. That's about a 42% gain from its current level. So just based on that, analysts believe that within 12 to 18 months, Disney could be back to where it was prior to the pandemic. I think that relies on a lot of things going right at a time when the economic data suggests that consumers are going to be cutting back on discretionary purchases, and certainly a trip to Disney would be considered a discretionary purchase. Certainly Disney Plus may be considered a discretionary purchase, excuse me. Plus, something I noticed is that short interest in the stock is up about 30% in the last month, and that means a lot of traders believe Disney stock is going to go lower. But as I said, ultimately the numbers will be what tell the story. For me personally, if the company paid a dividend that rewarded me for holding on to the stock during this time, I might be more tempted to be in on it. But in the short term, I'm not feeling the magic.
Chris, so you're telling me that Tinkerbell's faith, trust, and pixie dust just isn't doing us any good right now? That is
no, I don't think so. Not for me, at least.
That is not what the people want to hear, Chris. All right. Well, it's time to wrap things up. Thanks for your time today, Chris. We hope you all enjoyed this financial fairy tale. Let us know in the comments below, have you or will you change any of your Disney plans or purchases due to the story that this stock is writing? Don't miss out on the latest market trends and opportunities. Be sure to hit the subscribe button and that notification bell so you'll be alerted when we post our next stock analysis video. Seriously, go do it right now before you forget. Chris, have you done it yet?
I did.
All right, great. And while you're at it, head over to marketbeat.com where you can sign up for our newsletter and access all the tools you need to make informed investment decisions. All right, thanks again for joining us, Chris. We'll talk to you soon.
Thank you, Lacey.